Good evening. Thank you for joining us for tonight's presentation, Non-Traditional Long-Term Care Strategies. I'm David Balin and will serve as your host for tonight's program. With me today is our presenter, Ed Domanico, Field Vice President of Pacific Life Insurance Company. The presentation will last approximately 45 minutes and be followed by a question and answer session. To ask a question, click on the chat button on the small join.me toolbar and type your question anytime during the meeting. The questions will be saved and addressed during our questions and answer session following the presentation. I ask that you keep your questions general in nature, as we will not be able to address individual concerns during this presentation. Ed Domanico is a chartered financial consultant and chartered retirement plan consultant. He has 17 years experience in the financial services industry. Ed has planned over 350 retirements and has experience in both traditional and non-traditional law products. With that, let me turn it over to Ed for tonight's presentation.
Thank you very much, David. I appreciate it. And hello to everyone on the webinar. As David said, my name is Ed Domanico. I am a Field Vice President with Pacific Life Insurance Company. And what we're going to do during tonight's webinar is essentially walk you through a prepared deck as efficiently as possible. So we'll get through the deck in about 30 to 45 minutes, as David had said, and we'll field some questions at the end. My goal here is not to give you an in-depth understanding of long-term care and how Medicare and Medicaid work, but more of a 30,000-foot overview of what your opportunities are, what your options are, and so forth. I might also add that with the holidays fast approaching, long-term care insurance makes a great gift. It is an outstanding stocking stuffer or a good first night of Hanukkah gift as well. So without any further ado, we'll get into today's presentation. As many of you know, a large part of living well in your retirement is planning ahead. And many of you are doing that planning with David. And you're wisely nurturing your financial well-being, diligently saving throughout your career and your working years. And the result is that you've built enough of your savings to hopefully last you throughout your retirement and provide you with a rewarding retirement. Now, most of you also understand that there's an important component of protection that needs to be addressed as well. So protecting yourself against risk. So many of you have purchased health insurance and instruments of dental insurance to help protect your families in the event of medical emergencies. You may have also addressed life insurance and disability concerns as well during your working years. However, what we're finding is there's a significant component of protection that's missing. And for some people, this could upend even the most solid retirements. So today what I'm going to show you is a way to help defend your retirement against those unexpected incidences. We got a little bit of disclosure here that we can work our way through. I will leave that to some private. Dates this up on his website, and we'll get into the presentation. Now, saving and planning for retirement has been a challenge in recent years, and a lot of that challenge is due to the weakened economy. There's been a lot of economic uncertainty with some of the stock market collapses in 2000, 2001, and then again in 2008. And then also life expectancy has increased and continues to increase as there are advances in medicine and people are exercising, living longer, and that's pushing out their life expectancy, which is a good thing. However, it's also providing for a challenge in your retirement. So if you're like most people, your pre-planning is probably considered inflation and an emergency fund and the standard of living that you want to enjoy. But long-term care is rising in cost as well. And it's rising faster than the overall cost of or cost of living. So the average rate of increase every year on long-term care costs is roughly about 3.95%. So that also provides some additional challenges because again, you're coming up against a smaller dollar. Oh, hold on. Very good. Now, the rising cost of care can upend even the most solid retirement plan. And in the U.S. today, annual long-term care costs in a nursing home, a facility care cost, will average anywhere between $85,000 to $90,000 a year. And with that inflation rate that I mentioned earlier, the 3.95%, 20 years from now, when we're looking out at the year 2037, that same $85,000 cost in today's dollars will look more like $184,500. And as you can imagine, with a hole that large punched into the bottom of your retirement nest egg, it can drain your financial resources rather rapidly if one or both spouses were to incur a long-term care incident. Now, statistically speaking, we deal with a lot of statistics in our business, and when we look at the current graphic that's up, 7 out of 10 Americans age 65 and over are going to need some element of long-term care. So whether that's in-home health care, whether that's facility care, 7 out of 10 or 70% of Americans will need that type of care. And many of you may be thinking, that won't happen to me, and I'll be in that 30%, and you hope that you are. But at the same time, David and I are sitting on this side of the microphone, and we're hoping that we're in that 30% as well. So the statistics, may not come out in your favor, and if they don't, you want to make sure that you're prepared financially for any of those setbacks. So what are your options? So when it comes to managing the risk of long-term care expenses, many people believe that government programs will help, and may. Others may choose to buy a traditional long-term care insurance policy, kind of an annual pay type of situation, and some people hope to pay for long-term care out of their own assets, self-insuring. So let's take a look at these options individually. So the first option is the government will take care of me, and that may very well be the case. But again, these programs are programs that you don't necessarily want to have to rely on. You may be surprised to learn that these programs may not entirely cover your long-term healthcare needs. So there are several different Medicare programs, but each of them only helps pay for medically necessary healthcare services. So I'll say that again, that these programs will pay for only medically necessary healthcare services. So Medicare may not provide for any long-term care support, and services that help improve the quality of life aren't deemed medically necessary, and they may not be covered. There may also be limitations on the types and frequencies of services, as well as the deductibles and copays that are offered through these programs. So it's generally not the type of Plan A that when you're in facing that situation. Now, Medicaid coverage is generally only available to specific low-income individuals and families that meet the eligibility requirements, and those vary by state. So, Medicare and Medicaid may be able to help cover some of the cost of long-term care, but they're not going to provide you with that desired quality of life in your retirement. So it's for this reason that a lot of people, they consider shifting the risk to a long-term care policy. So let's take a look at what some of your options are. Now, for a lot of years, the primary option for private long-term care planning was traditional long-term care insurance, which helps cover the cost of care services beyond those that are not covered by the government-sponsored program. So traditional long-term care will generally help pay for medically necessary services as well as additional services that can help maintain a certain quality of life. Now, with traditional long-term care insurance, you pay the premiums and the amounts in advance, and you can budget for it. And the policy pays up to its coverage limits, for long-term care that you need when you need it. And typically the premiums are waived during the time that you're receiving the benefits. Now, traditional long-term care insurance is definitely a good alternative to supplement those government-sponsored programs. But what happens if an insured never reaches a point where long-term care benefits are required? So if you never need the care, what happens then? Or what happens to the money that's paid, that's paid in if the insured passes away and dies before needing the benefits? Some of the traditional long-term care carriers, they'll refund a portion of the premiums upon the insured's death. However, a lot of them don't. And additionally, many of the traditional long-term care insurance carriers, they don't guarantee the premium amounts. So the insured's premiums may rise as he or she gets older, and right about the time when the insured no longer has a steady income and can't afford the higher premium. So we're seeing that with several of the carriers out there that have been in this space and been offering long-term care coverage for a number of years. They've been faced with the specter of raising the premiums for their existing policyholders, and that's obviously never a popular decision. So there needs to be a distinct possibility that the policyholder might plan and pay for long-term care that's never needed, or that becomes too expensive just when they need it most. So we look at the next option, which is to self-insure. So self-insuring, by using retirement assets, it's the equivalent to self-insuring because you're using your personal funds in order to cover the potential cost of long-term care. Now, some people like the idea of self-insuring because they want to retain control of their assets, and they don't want any restrictions on how they can use the assets. And some people may also think they can afford to self-insure, so they've done a good job saving and they've built up a kind of a war chest of funds. But even those with significant assets could erode those assets very quickly. We saw the graphic a few slides earlier with regard to the inflation effect of these long-term care costs. And with a couple of bad years in the stock markets, if you're using and looking forward to leveraging retirement assets that might be invested in the markets, that's generally not a good play. Now, the other alternative is some of these non-traditional type of long-term care alternatives. So not something that you would pay annually, but you would pay it either on a one-time premium, so you're not pulling a premium into retirement with you, or on a short pay type of situation, over a 5, 7, 10-year period of time where you pay the premiums, you pay a little bit more because you're not paying it for the life of that contract, so you're paying a little bit more up front, but you are not burdened with the specter of having to pull that premium payment into retirement with you. So that helps you to plan a little bit more effectively for your day-to-day expenses when you do reach retirement, because you're not burdened with a $2,000, $3,000, or $4,000 a year cost for annual cost for long-term care. So, again, we do have a single pay product, Pacific Life does, and I'm gonna reference that of single pay long-term care insurance products, but I feel that our product stacks up very favorably against our competitors out there in the marketplace. And we're also very well positioned because of our late entry into the long-term care market. We are a company that does not have a lot of bad actuarial risk on our books that many of these other carriers that were very early to the long-term care party had. So I could talk about that in the question and answer session if anyone is interested. Now, what I'd like to do is just quickly walk you through what our Premier Care Advantage is. So it's essentially an opportunity for a client to reposition a non-qualified asset, basically an underachieving asset that may be sitting in a bank, a CD, a savings account, not something that's actively at work in the markets. And certainly not dollars that you need to live on. So if you have dollars in a bank CD and you need the yield on that CD to live on, then this would not necessarily be a good alternative for you. But if you do have dollars, rainy day type of dollars that you don't need to live on, but you can't afford to part with them either. So you can't afford to just set fire to them and never see them again. You want to make sure that those dollars will find themselves back to you, either in the form of care that's being provided to you, either in the form of a death benefit that's being provided to you, or as a return of premium or a refund in case you change your mind or need those dollars back. So that's essentially what our Premier Care Advantage product can provide you. So what you're doing, client will take the dollars from their left pocket. They will shift them into their right pocket. They still have control over that money, but now it's in the Premier Care Advantage wrapper. And immediately day one, that lump sum of dollars that they repositioned from the one pocket to the other pocket will multiply. So you get a day one bump, and it's usually anywhere between 2 to 4 times a bump, a multiple on the amount that was put into the Premier Care Advantage product. So I'm going to walk you through a quick hypothetical here. And what you'll see at the top of this slide is a hypothetical for a 60-year-old female non-smoker. So this is a 60-year-old female non-smoker that selects a 6-year benefit in our Premier Care Advantage product with a 3% simple benefit increase option to help keep pace with inflation. And we're assuming that she's married, so she's eligible for a couples discount. So with our product, and it's not just unique to us, but many of the other carriers as well, will offer a spousal discount, and ours is the equivalent of about 10%. So it's a 10% spousal discount, which will deepen your bag of money by about 10%. So this is a hypothetical portfolio where a client has $1 million, and that $1 million is allocated across 401ks and stocks, real estate savings, and cash. So a portion of that, what we're going to assume here, to keep the math simple, we're assuming that $100,000 of that portfolio is the dollar portion that's going to be repositioned for long-term care. So the client takes the $100,000 from their left pocket, puts it into the Premier Care Advantage wrapper, and as you can see in the box in the bottom middle, the age 60 box on your screen, day one, that benefit for that 60-year-old goes from $100,000 to a $382,326 bag of money. Now it's capped out on a monthly maximum of $4,940 on a monthly maximum, but that's on day one at age 60 what the benefit would be. Now, statistically speaking, that 60-year-old is not going to need that long-term care coverage at age 60. Statistically speaking, 2/3 of the claims on long-term care happen after age 80. So what we're also showing here is what that $382,000 bag of money that you had acquired day one will grow into over the next 20 years with that 3% simple benefit increase option. So as you can see on the far right, on the top box at age 80, that benefit has now grown to $595,000, a month maximum of $7,000, a little over $7,000 a month. So you're able to effectively keep pace with inflation and do so without sacrificing anything except for the opportunity cost on that $100,000. So what I mean by opportunity cost is if that $100,000 was sitting in your local savings bank and you put it into a 1-year CD or a 5-year CD, whatever percentage you can get on that CD, which right now is not overly attractive, net of tax, you might be able to get 1% or 0.5% on that money, but that would be what you would be giving up in exchange for this long-term care benefit. So it's essentially an opportunity cost discussion. Now, for a 60-year-old male non-smoker, what you're looking at is, again, similar assumptions with a 6-year benefit, a 3% simple benefit increase option. Again, we're assuming this individual is married. and the same $100,000 asset reposition. And what you can see for the 60-year-old male, the day one benefit multiplies that $100,000 to a day one benefit of $365,978 with a monthly maximum of $47.28. 20 years later, again, statistically speaking, that's when the majority of your clients or of your claims will happen after age 80. That original number will have grown to $570,245 with a $7,565 monthly maximum. So you can see the effectiveness of this approach, because with a one-time asset reposition, you can effectively defend your retirement from the impact of long-term care costs on the portfolio. So instead of bearing the brunt of that $570,000 cost from your own personal portfolio 20 years from now or 30 years from now, you're essentially transferring the risk to the insurance company. Now, when we take a look at long-term care in general, if you need long-term care, you're reimbursed for the covered long-term care benefits up to the policy's monthly maximum benefit amount, and you'll receive the benefits from anywhere from 2 to 8 years. So, the example that we showed in the earlier slides was for a 6-year benefit, but you can select the benefit period anywhere between 2 years to 8 years in 1-year increments. And again, you would choose that at issue of the policy. But this is where knowing your own family history and longevity with respect to your family tree, you can make a determination as to whether or not you might need a longer benefit or a shorter benefit with more monthly maximum or less monthly maximum. You also have the option to choose from 3 different inflation benefit options. So to help these policies keep pace with inflation, we have a 5% compound benefit increase option, a 5% simple benefit increase option, and a 3% simple benefit increase option. Of course, it's also available without the inflation protection as well. And that helps to ensure that your benefit dollars will grow with the rising cost of inflation and the long-term care. Now, your total long-term care benefits would grow by this percentage on each policy anniversary. So it's not something to where you'd have one benefit at age 60, but you wouldn't get any increases until age 80. Every year along your timeline, your benefit will increase commensurate with whatever benefit increase option you had elected, so that in any given year, when you have your own illustration done, you can trace your finger right across the ledger page and see what your benefit would be in any given year. Now, your covered expenses are reimbursable if you choose to receive in-home health care, thanks to a 0-day elimination period. So there's a 0-day waiting period on in-home health care. And the elimination period is, the total number of days that needs to pass between when the insured is deemed chronically ill and begins receiving the covered long-term care services, and when the long-term care becomes payable. So a 0-day means that, I mentioned being deemed chronically ill. That would mean that you were not able to do 2 of the 6 activities of daily living, or if you were severely impaired cognitively. Those would be the triggering devices for this policy. So essentially 2 of the 6 activities of daily living and or severe cognitive would trigger the care. So now the activities of daily living is basically bathing, continence, transference, toileting, and such. So again, you've got the overall triggering mechanisms covered here. Now, with facility care, there's a 90-day deductible on facility care. So with respect to that, what you would be doing, and again, the system, Medicare and Medicaid will pick up the first 90 days, or a good portion of the first 90 days. The first 21 days are picked up 100%. Whether you're Bill Gates or whether you're Ed Domanico, the first 21 days are picked up, and then from day 21 through day 100, there's a portion of that picked up by Medicare, and anything above the first $100 a day is then picked up by the individual. So when you get an understanding of what your exposure is here, having a 0-day in-home health care deductible is something that is an important element to the plan, because again, that's generally where folks are looking nowadays with respect to this care. People don't want to necessarily be taken out of their home, and if the care can be provided in the home, that's what they would prefer. So it's good to have a coverage that will provide for that. Now, with respect to what happens if you never need long-term care. So, you could surrender your policy at any point in time and get the initial return of premium benefit, less any policy loans or withdrawals that were taken out from the policy. So essentially, if in that example earlier, if you had put $100,000 into this policy and a day later, 10 days later, 10 years later, you decided that you needed to take that $100,000 back, you could take every penny of it back. There's no account termination fee or no surrender charge that's associated with this policy. And if you end up not needing the care because of death, so if you were to pass away prior to needing care, there's a death benefit associated with this policy as well. That will get you back not only your $100,000, if that was the amount you had paid in, but also a small death benefit on top of that money that was paid in. So you're not parting with those assets for the beneficiaries. You can pass them on to your children or on to a designated beneficiary through a death benefit if you were not afflicted with an illness and needed the care. Now, as far as additional benefits, again, and this is something that's offered through the Pacific Life policy, but it's not unique to us. We offer a couples discount, as I mentioned earlier, so that's a 10% discount, which will deepen your day one bag of money that can be used for in-home health care and facility care. And that couples discount is available for married couples or if you're in a recognized state civil union, so same-sex marriages in states that recognize same-sex marriages. Also, we offer an international benefit, which is something that is somewhat unique to Pacific Life. There are a handful of other companies out there that do offer it, but our policy will pay for the first 2 years internationally. So what we're finding is a lot of folks are retiring to other places. They're either retiring maybe to an island or back to a favorite country, or Europe or Israel or what have you. The first 2 years of care on our policy could be used internationally. If you had elected, let's just say 2 years could be paid for internationally, but if you wanted care in the 3rd to 6th year, you would need to come back stateside for the remainder of the policy length. But again, it is a good option to have out there. Now, the other important element when you're dealing with and shopping around for this type of care and coverage is help coordinating the care on the back end. So when you do go on claim with policies like a long-term care policy, there are a lot of moving parts associated with care coordination. And the Pacific Life Premier Care Advantage product, what we've done is we've partnered with a company called Univita. Now, Univita is the largest third-party care coordination and claim coordination company in the country. And what Univita will do is they will dispatch a local nurse or caseworker to sit with the family, sit with the adult children or the healthy spouse, and help guide them through the claim coordination and the care coordination process. So whether that's coordinating specialists for care, or whether that's just making sure you're able to maximize your monthly benefit in your retirement, those are all elements of the care coordination services that are provided through the policy. Now, with our policy, we don't charge any extra for that. That's baked into our policy, and it's something that is a critical part of the servicing of this on the back end, because again, it's good to have somebody advocating for you whenever possible. So why plan now? Well, most people first learn about long-term care when they or a loved one needs the care. Now, at that point, their options are often limited by the lack of information, the immediate need for services, and insufficient resources to pay for the preferred services. Now, planning ahead allows you to have a lot more control over your future and helps you understand what service options are available in your community, what special conditions may apply for receiving services. For example, things like age or other eligibility criteria. What services cost? What is the cost of having somebody come into the home? What are your payment options? Public or private? Having this information helps you ensure that you'll have a range of options if you need long-term care, and it makes it more likely that you'll have a lot more choice and control over where and how essentially you receive the services. Now, planning ahead is also important because the cost of long-term care often exceeds what the average person can pay from income and other resources. So with planning, there's a greater likelihood of being able to leave an estate to your heirs, pass some wealth down to the next generation, because you're less likely to use up all of your financial resources in paying for that care. So, and finally, for many people, one of the most important advantages of planning ahead is to ensure greater financial independence should you need the care. And your choices for receiving the care outside of a facility and being able to stay at the home and receive services in the community that you're familiar with for as long as possible, or greater than you or greater if you planned ahead. Now, the Premier Care Advantage, it can also increase the funds that you have available to help pay for your long-term care should you need it. So these benefits are tax-free benefits. So when they're paid out to you or they're paid out to the provider, they are paid out as a tax-free benefit. When they come to you in the form of a death benefit, if you were to pass away without needing care, it's a tax-free death benefit. Better yet, the Premier Care Advantage provides you benefits even if you never need long-term care. So you can surrender your policy at any point in time for your initial premium back through a return of premium benefit. And again, if you pass away, as I mentioned earlier, without ever receiving the long-term care, your beneficiaries will get that tax-free death benefit as well. So unlike a lot of other forms of long-term care insurance, the way this product is currently set up, it's set up as a now, we are also in the process of launching the next generation of this, which is due out on January 2nd of this year, which is going to offer a short pay option where you can choose to pay over a 5, 7, or 10-year period of time, either in an annual payment or a monthly payment for a short pay type of arrangement. So, again, you won't be bringing a premium payment indefinitely into your retirement with you, but it can make it a little bit more approachable and a little bit more attainable for folks that may not be currently sitting on a large lump sum. Now, as far as the underwriting on this, currently on our product, it's a simplified underwriting approach. So it is a phone interview. It takes anywhere between 30 and 55 minutes, depending on the interview. On the screen here, I know it says between 30 and 45 minutes, but generally, if the applicant is 50 or over, it's going to involve a cognitive assessment. So that usually takes about an additional 10 minutes or so. And so again, the phone interview process is relatively quick and painless, but there are no paramedical exams, so there are no labs that are being done. Nobody's coming out to the home to visit you to take any fluids from you or anything along those lines. And there are no attending physician statements that are ordered on this product. Now, that's something that speeds up the underwriting process considerably. So from the time that you hang up the phone after that phone application, you'll have your underwriting decision typically within 2 to 5 days. So there's one page of knockout questions that I'll leave the kits with David. So anyone who's on the webinar that is interested in attaining a kit, I will leave a stack of them here, and David can walk you through them or send one out to you. And again, once the application is processed, like I said, within 2 to 5 days, you'll have your underwriting decision. It's either a pass or fail. You either get it or you don't. They will do, Pacific Life will look into the Medical Information Bureau. So that's a database. Anytime you go to the doctor within the last 3 to 5 years, that's cataloged in the Medical Information Bureau. We will also look in the prescription database and the motor vehicle database as well. So from that and the phone interview, we'll then get all the information that we need to make a decision with respect to insurability and whether or not you're able to get the coverage or not. Now that concludes the webinar and what I had prepared for you tonight. What I'd like to do is just open it up to any questions that anyone has, and again, if I could be of service, you can either fire the questions off to David or to myself, type them into the chat box. Or if you think of something when you pull your head off the pillow tomorrow morning, you can certainly reach back out to either David or myself. But I'll turn it back over to David.
Ed, thank you very much. I think that was really informative. I have the chat box open, and I see already we have the first question coming in. And it deals with the fact that you were giving the example earlier of a person who had $100,000 that they didn't need. And the person who's writing in the question is, what if you don't have $100,000? What would be the solution for someone in that scenario?
Yeah, that's a great question. Again, we use that $100,000 number. It just makes the math a little bit easier, but that's by no means the minimum amount or the minimum point of entry on this. Now, the minimums and maximums on our single pay product are predicated on that death benefit. So for that example that we had gone through previously with the 60-year-old female non-smoker that put in $100,000, that $100,000 gave her a day one death benefit of close to $120,000. So the minimum amount is whatever would support a $60,000 death benefit. So for that 60-year-old female non-smoker, the minimum point of entry on this would be a $50,000 one-time deposit. If you're 50, you might only need a $40,000 lump sum to obtain the coverage. Now, once we launch our short pay option, that 5-pay, 7-pay, and 10-pay design, you'll be able to then obviously spread it out to a smaller, more achievable amount. And again, what we're anticipating is folks that may come into chunks of money, either in the form of a tax return or a year-end bonus or something along those lines, where they want to address long-term care and do it in a way where they can just write one check or maybe write a series of checks throughout the course of the year. I think it'll make it a lot more attainable for those folks that are looking to get in at a lower price point.
Okay. Another question that we have here is asking about how difficult it is to get through the medical underwriting process. What kinds of things does an underwriter look for what are the red flags, and what kind of solutions might they be?
Yeah. I mean, that's a great question, and like I said, in the kits that I'm going to leave behind, there's one page of knockout questions, and those knockout questions are a lot of the things that you probably might expect. So, have you ever been declined for a long-term care policy in the future? There is a very thick black line between yes and no on these knockout questions. So if you are a yes to any of those questions, you are an automatic decline on this product. But there are a couple of things that are a little bit curious on there. So there's one question on there that has to do with cancer. So it's cancer treated or diagnosed within the last 12 months. And this is where it's important to be upfront and honest, but don't be overly forthcoming. Answer only the question that's asked. So the question that is asked is, cancer treated or diagnosed within the last 12 months. So if you are 10 years cancer free and no longer under care, when you are taking your telephone interview and you're asked that question, the answer to that question is no. It's not no, but I'm a cancer survivor, 10 years cancer free, and so forth. Because keep in mind, there are no attending physician statements that are being pulled on this underwriting process, and because there are no medical labs being done, we're just dealing with the most recent medical history. So you want to be truthful. You want to answer all the questions truthfully, obviously, but you want to be treating this like an IRS audit. Answer the question that's asked and only the question that's asked. But generally, again, that will cover kind of the majority of the underwriting concerns. The other thing that's a little bit curious about this product, because one of the questions on that knockout list is, do you have any medical tests pending or surgeries pending? And oftentimes when you get up into your 60s, you may run into a situation where you always have kind of a long-standing medical appointment on the books, whether it's an annual or a colonoscopy or what have you. So what you want to do is that won't automatically knock you out, but what the underwriting team will want to do is they will want to wait until the results of the colonoscopy are in or what have you. So if you have something that is not critical to be scheduled, and you're interested in taking a look at insurability for long-term care, if you can put off that test until you go through the long-term care process, then certainly you can do that. If it's something where you can't postpone it or you don't want to postpone it, which is certainly understandable, then you may want to just postpone applying for the long-term care until that medical test is kind of cleared off your radar screen.
Great. Actually, and one thing I'll bring up here is that tonight's topic was non-traditional long-term care strategies. Let's not forget that there's a lot of traditional long-term care strategies. So while we focused on one type, there's still traditional long-term care insurance. There's long-term care insurance that is written as part of a life insurance contract. There are products that are written through an annuity. There's a lot of different options out there that the client might want to consider as well.
Sure.
The final question I'll throw out there is that there's been a lot of press recently about long-term care insurance companies raising the premiums after a person has purchased a policy.
Sure.
Pacific Life's position in that regard.
Yeah, Pacific Life was late to the long-term care party. So there, as you mentioned, there have been a lot of big name carriers out there. I won't name any of them, but they have gone through and actually provided notices to their existing policyholders, notifying them that their premiums are getting raised anywhere between 20, 30, 40% increases to their existing premiums. And as you can imagine, when you're living on a fixed income in retirement, or even if you're not living on a fixed income and you're still working, getting a premium increase of anywhere between 30 to 40% is something that is not an easy conversation to have. So we are late to the long-term care party. We launched our product in January of 2012. So there are a lot of other carriers that have been in this space a lot longer than us. Now, when we launched our product, we did a lot of research, and we actually recruited away folks from a competing carrier that had a wealth of experience in this asset-based long-term care product that dated back to the 1980s. So we got all of their experience, and we consulted with them in the design of our product. And what we asked them when they came over was, if you could have created the product differently, what would you have done differently to the creation of the product? Because we had the opportunity to build it from scratch. And that was the framework of how we built our Premier Care Advantage product. That being said, because we were late to the long-term care party, and that party, David, is a party that you wanted to be late to. If you were an insurance carrier, you did not want to be early. You did not even want to be fashionably late. You wanted to be very late to that party. And the reason for that is we, as insurance carriers, actuaries, they did not have a good understanding of the risk of long-term care 30 years ago, like they have today. And the older policies written 25 and 30 years ago, and even as recently as 15 years ago, 10 years ago, these policies were written with lifetime benefits, and they were written with compound benefit increase options that were not priced appropriately. So in other words, the insurance company did not do an adequate job pricing these based upon the amount of risk. All of those factors we talked about earlier in the webinar, with people living longer, advances in medicine, pushing out life expectancies, that is something that is very good unless you are an insurance company that has to pay a long-term care claim for, an Alzheimer's patient that may be on claim for 10 or 15 or 20 years. So that being said, because we don't have any of that lifetime risk on our books with the lifetime benefits and any of the mispriced benefit increase options, we are in a very good position. The premiums, when a client commits to a policy at Pacific Life, Pacific Life will guarantee that premium. So they will guarantee the care. They will guarantee the amount of that money bag, consistent with the illustration that was put in place when the policyholder got that policy. So that's something that we will not be going back into existing policyholders and sending them letters or knocking on their door with our hand out looking for more money. What we will do is reprice the existing product moving forward for new people coming in. And we've already actually done that once with this product. So when we originally launched the product in January of 2012, that same hypothetical example that I gave earlier in the presentation for the 60-year-old female non-smoker, when we launched, if you recall, present day, that $100,000, day one gave that individual a $382,000 and change benefit. When we first launched this product in 2012, for the people that had just gotten in on that product, that 60-year-old female non-smoker would have gotten a $414,000 bag of money. So when we repriced, which was back in May of last year, not May of this year, but May of last year, what we did was we just made the money bag a little bit more shallow. But for folks that already have it, they've got it guaranteed, and the whale will be the amount that we contracted to. It's a good question.
Very good. Thank you so much, Ed, for coming in tonight and holding this webinar. I know that there's probably more questions out there that are more specific to individual needs. And as you think of those things, you can certainly drop me an email or give us a call, and we can help design a strategy for you. Thank everyone for their attendance tonight. And I remind you that our next session will be the second Wednesday of January. Second Wednesday of the month is always our date. On the second Wednesday of January, we will feature Bo Barnett from Loring Ward, who will be talking about how to structure an investment portfolio and what's the proper allocation. So until then, I wish everyone good holidays, safe travels, and we'll see you in a couple weeks.